I analyzed over 1,000 crypto portfolios and found the blueprint for successful crypto investing. If you don't know me, my name is Robin. I've mentored over 1,000 crypto investors and helped them to get from $10,000 to $100,000 and from $100,000 to $1 million. So let's get started. So this strategy is especially for people who don't have too much time for crypto, but still want to have allocation to that space and start to earn money. So we will cover 4 important things. First of all, we will cover the portfolio distribution. Here we will talk about the barbell strategy. Then we will talk about timing the market and how you can basically decide when you sell and when you enter the market. And I will give you like a very easy strategy. And lastly, we will go over some risk management lessons that are very important if you want to succeed long-term in crypto and not just for the next couple of days or months. This will help you to basically navigate the market, exit in the right time, and have the right mindset when it comes to choosing the coins to invest in and also some other things. So let's get started. First of all, the barbell strategy. So what is the barbell strategy? You see some notes underneath the beautiful barbell right here and the beautiful whiteboard I prepared. So first of all, you basically split your portfolio into 2 sides. The one side is the high risk side and the other one is the safer side. When we can, like, crypto definitely is not the safest place, but we want to have the most secure crypto investments, which definitely go up in value when the market in general rises. So the assets that you can choose for the safe side of things are Bitcoin, Ethereum and Solana. You don't want to hold any other currencies because most of them have no proven track record that they perform over multiple cycles. Also, when you look at adoption, most of them don't have a real adoption, even the bigger ones. And BTC, Ethereum, Solana are just the best picks here when it comes to security. So here you want to play it very safe. You want to hold those assets just to use the capital inflow into the crypto market and just see your portfolio appreciate when the overall crypto market gains attention and we get into a bull run like we are right now. So the other 20% is the high risk side. So here you should be very careful with the coins you select. Now, a lot of people start and think, okay, I want to be in every single coin there is on every single narrative or area in crypto because you don't want to miss out. And this strategy is especially important, or it's really important for every strategy out there, that you minimize the coins you hold in your portfolio. Now, to tell you exactly how many coins you should hold, the sweet spot is 7. So there are 2 types of risks in the crypto market. The one is the market risk and the other is the unique risk. Now, market risk refers to the overall risk to the crypto market. Now, if you have events that will damage the whole reputation of crypto or will lead to a massive sell-off, this is a market risk. You can't diversify against it. So at least in the crypto space. So there's no coin which you can hold in that time which won't depreciate in value. So the market risk is something that you should just calculate, or just like you should play around it with your investments, like with your entries and exits. And the unique risk, on the other hand, is referring to the risk of a single investment. And here you want to diversify against. And you do this by holding multiple coins in multiple categories. So you can either, like categories in crypto, just to make that very clear. You have, for example, in this bull run, you have AI, you have real-world assets, you have meme coins, you have layer 1s, you have layer 2s, and so on and so forth. And you want to decrease the unique risk of your portfolio as much as possible. So you can do that by 2 things, basically. You can, first of all, say, okay, I decrease the unique risk of my portfolio by holding only very small positions. And you can decrease the unique risk of your portfolio by basically saying, okay, I diversify over multiple areas in crypto and by holding just multiple coins. So what you don't want to do is just be invested in one single area with your overall portfolio. Only if you know what you're doing, you can do that. But in most cases, I would say, okay, find like the top 3 narratives in the current bull run. So for example, it could be AI, RWA, so reward assets or AI. And then you just diversify above them, and then you don't want to hold more than 7 coins. But because the interesting thing that happens is if you hold 7 coins, the unique risk of your portfolio, you basically diversified enough against it, so the unique risk is not really a risk anymore to your portfolio. The only risk that is left is the market risk. So this is why you should hold 7 coins. Now, if you start holding more than 7 coins, something weird starts to happen. So usually you think, okay, I diversify against risk, but there's no risk that you are diversifying against anymore. So what is happening if you diversify even more? Now, you just decrease the potential returns. And when you think about why you hold so many coins, maybe it's because you want to diversify, but also because you have FOMO. You think, okay, maybe if I don't invest in that one specific coin, then I will miss out. Or if I don't invest in this specific area, then I will miss out. So you will end up with a lot of different coins and a lot of different categories. And in the end, you only decrease the potential returns of your portfolio. So that is not what you want. Like, you want to maximize the portfolio returns. On the other hand, you also want to decrease the risk. And the sweet spot here is 7. There are countless studies who show that. And this is not only true for crypto, this is also true for the stock market. For the stock market, the amount of stocks you should hold is, I think, 15. So there are a lot of different, like this thinking or this principle also applies to other markets. So you shouldn't hold more than 7 coins. And if you hold more than 7 coins, you need to have a really good reason for that. So again, you have the safer side of your portfolio and you have the less safer side of your portfolio, the high risk side. And as you see the barbell portfolio or the barbell strategy, you might be wondering, okay, why is the name of this strategy the barbell portfolio? Because 80% is more than 20%. Now, all of that gets managed by the risk you have, by the position size. So because you hold 80% of your portfolio in safer assets, the risk associated to this side of your portfolio and the risk associated to the 20% side of your portfolio, because you hold less value on this side, you basically decrease the risk of the high risk side, and it comes close to each other. Now, the safer side in crypto is there for consistent growth. You want to benefit of market growth, and this is why you have the safer side. The high risk side is there for outperformance. Now, if you have this portfolio in place and you underperform Bitcoin, this means your high risk side needs to get optimized. So this is very important. Like, you don't want to diversify and hold only 20% in altcoins if your portfolio underperforms Bitcoin. Bitcoin is always the benchmark. Now, this is the portfolio structure, which works really, really well in every single case. Like, you don't have to be a rocket scientist to understand that. All right, now time over timing. So a lot of people, especially right now when the market is going up, they try to snipe bottoms. And this strategy is also called the lump sum strategy. You basically try to identify a specific price and then you just buy everything at that one price. Now, the DCA strategy is especially good in the accumulation phase, but right now we are on an uptrend. But you can still use the DCA strategy. And the only thing that changes is the general time frame. So in the accumulation phase, you have a couple of months to basically position yourself on the market. When it comes to the current market phase, we are on an uptrend, everything is going up, and you don't have that much time than you had in the accumulation phase. Now, it basically, the only thing that changes is the time spent. So you try to decrease the amount of time that you use for investing into the space on a regular basis. You can also do some bigger, when you see a big drop, you can also increase that single sell. But basically what the DCA strategy is that you set a time frame for a specific amount that you invest, and I just show you an example. So for example, let's say we are in an accumulation phase and Bitcoin is ranging somewhere between $30,000 to $40,000. Now, if you start with $10,000 in month one and just buy everything at once, you might think, okay, yeah, $30,000 is lower than the $35,000 in month 4 and the $40,000 in month 5. So, and this makes you think, okay, yeah, I still got a good deal. But the more chill strategy, where you basically say, okay, I buy Bitcoin every single month for $2,000. Let's say, let's take the example with the $10,000. You end up with more. All right, this is not correct. Like DCA and lump sum should be switched. So the lump sum strategy leads to 0.333 Bitcoin, and the DCA strategy, where you buy over a consistent period, leads you have more Bitcoin in the end. Like you have 0.3538 Bitcoin, meaning you increase the stack of Bitcoins you hold and you lower the average entry. And the reason for that is pretty simple. Like most people out there, like maybe they think they can trade, but I can guarantee you, like only a very small percentage of people know how to actually use TA for finding entries. And also a lot of, like, when we are in an accumulation phase, a lot of people always think that the price will go even lower. So you wait and wait and wait and wait. And in the end, you get a worse entry, because then you FOMO in when you see the price of Bitcoin rising to $40,000 because you waited for too long. And the same is also true for the uptrend. Right now, we had, like, I don't know when this video gets released, but basically we had a drop. And a lot of people now think, okay, should I buy now? Should I wait? But in the end, they wait too long. And it would have been easier if they just decided, okay, I will buy now for the next 2 weeks and enter my positions with an average price of whatever. I don't care about like trying to hit the bottom, because in the end, the 1 or 2 percentages that you gain by being active 100% of the time and like looking at the charts and drawing crazy pictures, so on and so forth, like this leads to underperformance. So what I would rather do, it's more time efficient, just DCA in. And when it comes to exiting your positions, it's basically the same. You just get out of the market as soon as we get into the distribution phase. Now, for the people who don't know what the different market phases are. So we have the accumulation phase, we have the markup phase, we have the distribution phase, and then we have the downtrend. And then this cycle basically repeats itself. Now, how do you see that the distribution phase starts and you basically go from an uptrend into a distribution phase? There are 1,000 ways to do that. I will focus on one very simple one. It's basically all about, okay, how is we do a sentiment analysis now. So how is the market reacting to positive news? Now, when, for example, Trump gets into the office, and you see him posting stuff about Bitcoin, but the price of Bitcoin or the price of crypto in general is not reflecting that bullish behavior anymore. When you basically see a lot of positive news, but the market is not reacting to them, basically saying, yeah, I don't care. The market is moving sideways for a couple of months, then or weeks. Then you usually can say, okay, that we reach like a certain top. Now, I have a video which basically tells you exactly how to spot those market peaks. And just like, I will link it somewhere here, so you can click on it and go further in that topic, and later on come back to that. So, or maybe watch it after the video. All right, so now you know when to exit your position. So how do you do that? Again, you don't want to be the person who tries to snipe the top, because then again, you will face some emotional struggles. So for example, you saw the price of Bitcoin going, let's say, to 121,000, and the price drops to $115,000. Now, in your mind, you basically set an anchor at the price of $121,000. Now, this leads you to, again, acting emotional and having not a proper decision-making framework. So you wait for the price to come back to $121,000. But for most people, this price then, let's say this price never gets reached again. So you have your anchor here and the price drops and drops and drops and drops. And in the end, you have a much worse exit than you would have had if you just exit it over a period, like you basically just DCA'd out. So again, like just watch the video on market peaks. As soon as you start spotting them, you should start exiting your positions. Now, again, you can do that either via like percentage increases. Now, for example, you can say I DCA out in terms of, okay, every time when I make 20% or 30% on my safer positions, I exit a certain amount and just like do this over time and have like, and basically sell on the way up and not on the way down. Or you say again, like, okay, as soon as you saw or as soon as you spot those peak signals, you can say, okay, right now, chances are really high that the price of Bitcoin drops. So what I will do is I will start selling now over the next 2 weeks, and then I'm out of my position. Chances are that I maybe miss out on the perfect top, or I maybe secure myself against a further downfall. But this way you are secure that you are not risking too much, and you are basically like the chances for you acting emotional are getting smaller and smaller and smaller, because when you have a system in place, then you only need to follow this system. And as you see, this is extremely simple. And this is also why I chose this strategy. Like in crypto, like in general in investing, the simpler your decision-making framework, the easier it is to follow it. And also, most of the time, complex systems are not directly correlated with higher profits. Like the easiest, like the whales, the big players, what they do is they buy in an accumulation phase and sell on the way up, and they don't care about hitting like the perfect top. And when they buy, they don't care about hitting the perfect bottom. Now, this is how you basically enter and exit your coins. Now, let's talk about risk management, especially when it comes to the high-risk altcoins you choose. You want to focus on not losing money, and rather than chasing gains. A lot of people out there focus only on finding the next 100x. And then they invest, let's say you have a $20,000 portfolio and you find a coin that promises to be the next 10x or 200x. So you buy it with, let's say we have this this portfolio distribution, 80% is in safe assets, meaning that of your $20,000, $16,000 is in crypto, is in the safer side of things, and the $4,000 are there for higher risk opportunities. Now, the uneducated investor will say, okay, I have $4,000 for high risk opportunities. This one specific altcoin promises to be the next 10x, so I buy it with my $4,000. I don't care about diversification. So what happens now, we talked about unique risk beforehand, the unique risk of your portfolio goes up a lot. And if this one specific coin goes down by a lot, the overall portfolio value will also decrease by a lot. So you should also diversify here, and your position size should consider the overall, like how much you want to or are able to lose. You don't want to lose money on every single coin, which basically again leads me to the point, you shouldn't over diversify, but you also shouldn't under diversify. So have positions where you have a clear thesis, meaning you have a clear understanding of why this coin goes up in value. And you don't need to gamble. Like you can put risk into your portfolio, but calculated risk, meaning you hold coins where you are certain that they go up in the future, and not just, and you don't just think that based on a buzzword or a marketing announcement on the website. And this is also why I say position size matters a lot. You don't want to invest too much into high risk opportunities, no matter how promising they look. So always consider that there is the unique risk, and you need to split those 4 coins. And in the high risk side, you want to split the investment you have for those over all of those positions. Now, you can say some of those positions are less risky because, let's say, you buy an AI coin like Render, for example. The market cap is already quite high, but it's still, you can consider it as a high risk opportunity because the potential also looks still okay. Now, you can also say, okay, Render has less risk associated to it, which is why I say I don't hold, I can hold more of my high risk side of the portfolio in Render, or when you go up the risk ladder, and you enter like the high speculative area, then you can say, okay, this is where I only invest like a very small amount compared to the render position. Now, position sizing helps you to manage your risk. Understand how much are you able to lose, and based on that, you don't want to hold like $2,000 in the biggest shitcoin on earth, which has a market cap of $400,000. So position sizing is definitely one important thing. And the next thing which is important is do not use leverage. Now I will show you an example of someone who came to me 3 months ago, and he was someone who wasn't able to control his emotions. And it wasn't his fault, it was the fault of the strategy he chose. Like the strategy he chose was, I would say, not a real strategy at all. So what he tried to do is leverage trade, and he always was emotional, like I don't want to miss out, which is why I put like a 5x here, like a 5x leverage here, a 10x leverage here. So he increased his position sizes by borrowing money from exchanges. But the problem is, if you use leverage, the price where your assets or where your position goes to zero because you only hold, let's say, $2,000 and you trade with $20,000, if the position decreases by 10%, then you're already at zero because you only have $2,000 backing this one position. Now, this was a bit quick, but again, leverage trading, just don't do it. Like, don't use the nice exchanges like Binance for building up your portfolio scientifically, like with borrowed money, especially in the early phases when you don't know what you're doing. This usually leads to losses. So this is exactly what he did. Like, he traded on leverage constantly because he was revenge trading, because he wasn't able to control or to understand how to handle, how to do the position sizing and so on. And he was in crypto for quite some time, but made no money at all because he was leverage trading. And you could say, yeah, it's his fault. But the problem is that the more losses you face when you do those kinds of things like leverage trading and so on and so forth, you also you go into that circle of losing and trying to make it back again, losing, trying to make it back again, and so on and so forth. And you basically you are ashamed of yourself. And because of that, you continue with what you do because you hope to make it back. Now, I saw that, and I saw that I could help him by building a very simple portfolio, which is still positioned in a pretty good way. So when you look at the performance over the past 3 months, so today is the 6th of December. So I took this screenshot directly before I made this video. So he's up $21,000 over the past 3 months. More money than he ever made in crypto on his own and using his leverage trading strategy, which wasn't a real strategy. So he burned multiple accounts, and now, because he has a more chill approach, he's not over-rotating, he holds a couple of currencies where he's sure about the potential, has also the risk, like the safer side in crypto, and basically was able to build up that portfolio growth. Now, what we did with him is that we focused a bit more on growth. So his safer side is not consisting out of Bitcoin, it's only consisting out of Solana. So based on that, this performance looks like it looks. So we decided against Bitcoin because we thought, okay, the potential of Bitcoin isn't as great anymore, but we still want that safe side. So we chose Solana as the secure side of his portfolio, and then we positioned him in the AI space, where he also knew already some currencies and already had some expertise. So he understood what coins were better than better than others. So we decided to do that. He now holds only 7 currencies, is not leverage trading anymore, and makes consistent profits. And again, he started only with $7,000. And again, he has a full-time job, as a dentist, so he's not able to monitor the market constantly, which is also a reason why this strategy that he originally used was not fitting to him. Every strategy needs to fit to your lifestyle. So if you only have 2 hours a day, you can't trade. And if you have 16 hours a day and already very good knowledge, you can also do some short-term trading stuff. So then you can use then you can do the distribution of your portfolio a bit differently than you would do it if you have a full-time job. So this strategy is a very simple way on how you can make consistent profits in crypto, reliable profits in crypto, and without chasing every single trend there is. Just decide for the 2 or 3 best areas to invest in right now in crypto, have the safe side of your portfolio and this high-risk side. And if you make mistakes in the high-risk side, you still have that 80% of your portfolio, which is basically carrying your performance. So if you have a bad pick on the higher risk side, then it's basically not that, it's controlled. So you don't lose too much. All right, with that being said, now, if you think that is an interesting concept, and if you maybe are in the same position and want to get out of it, I have a free Telegram group where I drop daily investment knowledge. I don't show coins in there. So only knowledge on how you can use, for example, this strategy for your benefits. So you can find it underneath this video, or you just click the link somewhere here. All right, with that being said, subscribe and see you in the next video.